a lot of households are just going to sink because I think the economy is going to be so weak over the next 2 years that politicians, based on politics, are going to be forced to do something about it, to provide aid or stimulus or something like that. And so what's probably going to happen is we're going to have a compromise to get legislation passed. And what does that mean? That means the worst of both worlds. That means the Democrats get more welfare spending and the Republicans get every penny the government spends has to be collected in taxes. Government spending is taxation.
The October CPI data came in a bit cooler than expected, but the market reaction was hot and furious. Peter Schiff, an American stockbroker, financial commentator, and radio personality, broke down the CPI data and the market reaction to it in this video, as we are going to show you in a while. Despite the spin, Peter said the Fed isn't making any progress in fighting inflation. The headline annual price increase came in at 7.7%. It's the first time in quite a while we've seen a CPI under 8%, and it was lower than the 7.9% projection. This is the number everybody focuses on, but it's a little misleading. Some prices did fall in October, including new and used cars. But why are used car prices falling? People can't afford to buy them. People are spending so much money on food, they're spending so much money on energy that they don't have as much money left over to buy a car, used or new. And so, prices are going down. We're seeing the same phenomenon in shelter costs. House prices are falling, but mortgage rates, along with taxes and insurance, are spiking, keeping the cost of buying a house high. Keep in mind, inflation is worse than these numbers suggest. This CPI uses a government formula that understates the actual rise in prices. Based on the formula used in the 1970s, CPI remains is closer to double the official numbers, a historically high number. This is not good news. This does not show that the Fed is making any progress when it comes to inflation. Yes, the year-over-year number is lower than it was, 7.7. But that's still a big number. And of course, it doesn't even capture the degree to which prices are moving up. The real rate of inflation is probably double that. There is no reason to believe that at some point shortly, we're not going to print a record-high year-over-year CPI. Nothing the Fed had done thus far is going to succeed in bringing inflation down to 2%. We would now get into the video and listen with rapt attention as Peter Schiff delivers a breakdown of the economic situation. As you listen, make sure to hit the like button, subscribe, and drop your comments or questions below.
I think the main reason that retail sales are up is because prices are up. So again, this is not people buying more, this is just people paying more. And in fact, in many cases, they're actually buying less. They're just paying so much more that retail sales are up in dollars, but they're down in volume. But also, I think a more important factor is where are consumers getting all this extra money? Because we know that their wage increases pale in comparison to these price increases. Well, it's actually not a big mystery where they're getting their money. We know they're borrowing it. I mentioned on the last podcast that household debt just soared to an all-time record high, and so did credit card debt, with jumps that we haven't seen outside of a massive recession, which again is when Americans turn to credit the most because they don't really have any savings to fall back on a rainy day. So when it rains, they whip out their credit cards. And that is a big problem, especially when you have interest rates rising on those credit cards, interest rates rising across the board on all sorts of debt. And that debt burden is going to weigh much heavier on the debtors due to the rise in interest rates, not just the rise that has already occurred, but the rise that's about to occur. And of course, as households are experiencing an increase in the cost of servicing their debt, they're about to experience, or in some cases already are, a decrease in the value of those assets, especially the assets that are levered and are collateral against their debt, their homes. Over the last couple of years, real estate prices are still way up. So consumers still think they're richer, even though they're paying higher interest on their mortgage. if they have an adjustable rate mortgage or if they have a fixed rate mortgage, then they haven't been impacted by the rise in mortgage rates. But the way they will be impacted is as a homeowner, because the value of their homes is going to go way down. And as a result of the reverse wealth effect, they may end up spending a lot less, but also they don't have the real estate home equity to fall back on, nor can they tap into that equity through a home equity line of credit or something like that. That was a lifeline that in previous recessions, homeowners could take advantage of. Well, this time they're not going to be able to take advantage of it, and they're certainly not going to be able to do a refi. Refis were really the lifesaver for a lot of homeowners because they were able to refinance their mortgage into a lower rate, and in many cases they could extract some cash and do the refi and still lower their rate and withdraw cash because of the savings from the lower rate. Well, nobody can do that anymore. In fact, nobody wants to refinance their mortgage because the mortgage rates that exist today are much higher than the current rate. And so you can't do a cash out refi, because to do that, you would have to refinance into the current mortgage rate, and nobody would be dumb enough to do that, which means that piggy bank is empty and homeowners can no longer rely on it to pay the bills. So they're using their credit cards more, but at some point they're going to be tapped out there as well, especially as consumer prices continue to rise. So they have less saved.
Even if the Fed continues to hike rates, it'll never catch up to an inflation curve this it is miles behind. The only real way to fight inflation is a two-pronged attack, which would include positive real interest rates, and we need cooperation from the U.S. government. We need to see cuts in government spending, something that's not going to happen. Government spending is going to continue to increase, and so will the deficits that are making that spending possible. Peter pointed out that we still have stimulative monetary and fiscal policies with negative real interest rates and increasing budget deficits. These numbers aren't going to get any better. They're going to get worse. Because now, you have a falling dollar that is going to accelerate the increase in consumer prices. A strong dollar held down import costs. A weakening dollar will raise the prices of imported goods. But as Peter pointed out, insignificant or not, the Federal Reserve can use this CPI data to claim it is making progress in the inflation fight and ease off the tightening accelerator. We should not be deceived and try to look beyond the data presented. Things are getting worse and could even worsen in the nearest future. As Peter Schiff advised, you must act now to prevent hellish consequences later. If you enjoyed the video, make sure to like the video, subscribe, and turn on notifications. Thanks for watching.